Hello and welcome to another episode of The Express Economist. Many of you might have heard about two major events that happened in global economy this week. One, in the US economy, we found that the US Federal Reserve raised interest rates. And on the very next day, we got information that for two consecutive quarters, the US economy had contracted. And perhaps now it's just a matter of time before the US economy is declared to be in this recession. The other important event was the IMF coming out with the update on World Economic Outlook. And therein, IMF has dialed down the global growth outlook for many economies, in particular US, China, and India. Now, all of this has massive implications for India's future growth. We also know that Fed's raising interest rates has had impact on rupees exchange rate. To understand all of these things, I have a very special guest. Please welcome Ms. Renu Kohli, who is a long-time former RBI staffer, former IMF staffer, and a long-time commentator on India's economy. She's a columnist with several newspapers. Welcome, Ms. Kohli, to the Express Economist. And today we want to understand from her the implications of what the IMF has said, what the US Fed is doing on the Indian economy, and we'll look forward to what this implies for India's monetary policy. As many of you know, on August 5th, RBI will declare its next, review its next monetary policy. So what are the implications of all of this for RBI and for India's future growth? So, ma'am, if I may start by first asking you that, there was a lot of discussion before going into the Federal Reserve's meeting, whether the Fed will raise it by 100 basis points or 75 basis points. And ultimately, it was 75 basis points that the Fed raised it by. And now for 2 months, Fed will not perhaps tinker with it. So that is how it's going to stay. Every time Fed raises the interest rates, there is a decrease in the interest rate differential between India and the US. And that has its direct implications for India. If you could elaborate a bit about how this Fed action will have an impact on India's economy.
Thank you for this opportunity for discussing the Indian economy. To respond to your first question, Udit, the impact of the Fed interest rate increases, or in general, the monetary tightening in the US and changes in the world economy and the impact upon India. I find it quite useful to think of these shocks. After all, it's an external shock and a negative one at that. To think of it in terms of what are the channels through which it is going to impact India. So there are three primary channels. One is the trade channel, the second is the financial channel, and the third one is the confidence channel. So let's go one by one. And there is the large dominant expectation that the US economy is going to slide into a recession, or it already is into a recession. You mentioned the fact that the second quarter consecutive contraction of the US GDP has provoked or prompted a lot of discussion about whether the US economy is already in recession. That is debatable, but besides the point. The fact is that any slowdown, even though if it may not be a recession, and the IMF flags the slowdown of growth rates and in general of the world economy at large, but primarily of largest of the blocs, which is the US, EU, and China. So that the trade channel, obviously, it is the impact upon the Indian economy is through exports. India benefited during the pandemic year in the last 1 year, particularly by seeing very robust export growth. Although that export growth in part was quite dominated by the price effect, which is, there was an increase in commodity prices and so on. Yet the fact remains that the trade channel will impact India through lower exports. So, lower external, a slowdown in external demand is a negative for India. Next, we can look at the financial channel, and this brings to the point or points you raised about increase in interest rates, the impact upon the rupee, the exchange rate, the increase in interest rates in the US obviously is strengthening the dollar, and this has been going on for more than a year now, and the dollar index is rising. As a result of that, all other currencies, including the Indian rupee, are depreciating. For India, it is for actually all countries, because this globally we are seeing inflation. For all countries, this is inflationary, and the impact is directly upon the domestic interest rate. So the financial channel, one is through the interest rates channel. The second is through reversal of capital outflows. And these inflows on, or rather, the short-term capital, particularly into debt as well as equity, is largely governed, or I would say totally governed by two primary factors. One is the global risk sentiment, whether it's risk off or risk on. And the second is the search for yield. And within the search for yield, we can divide it further into the interest rate differentials between India and the US or any other economy and the US, and the growth differential between the India and the US. So these are the two mechanisms or the channels, sub-channels through which the financial effects take place. The third one is, or rather, governing overall this is the sentiment, which is driven by the liquidity, sorry, not the sentiment, but the liquidity, the global financial liquidity conditions. And the VO, the IMF VO, which has just been released, the July update points to a very significant and rapid tightening of global financial conditions, which is essentially your dollar liquidity. Between April to now, the first, the previous update of the preceding update of the IMF. So that is affecting India in a very severe way, because it directly results in tightening of Indian conditions within the domestic liquidity conditions because of various factors. And I will go to them at a later stage of our conversation. But for now, let me just confine myself to the financial channel and then move on to the confidence channel. The confidence channel is something which is the investor's risk appetite. As I said before, that these inflows or the global capital movements are largely, other than FDI, are largely driven by confidence, risk off, risk on mood. The FDI is also driven a lot although it is patient and long-term capital, yet it is driven largely by confidence and certainty or uncertainty. And this is something I would like to point out, that the commentary or the discourse that we have been seeing, or the public discourse rather, in India, has focused primarily upon the trade and the financial channels and less upon the confidence channels. Now, the confidence, or the risk off or risk on, or the degree of confidence, high or low, or depression in sentiments, directly translates into uncertainty. And what the Fed's conference, Chairman Powell's conference the day before, uh, basically just said that there cannot be any running commentary or forward guidance upon the evolution of. So, the distance between the two, the uncertainty, how high it is, there is a very interesting comparison in the VO as well, which actually testifies to the gap between how high uncertainty is in July 2022 as the distance between it's as high as it was in March 2020, almost at the same levels. And March 2020 was the time when the pandemic had exploded, not so much in India, but in the US, in Italy, and before that in China. So the uncertainty is directly related to investment and what businessmen look forward to. And so, that's not good news for India, or for that matter, any other EM, because India is seeing a very, very nascent recovery. There is government spending and whatever the little bit of fiscal room that was there, and that also driven by borrowing. The government is trying to, revive the economy, stimulate. Even consumption hasn't come back so far. So investment, the confidence channel has a very depressing effect upon business investment, and that is something which will which does have a longer impact than the near term. Even though inflows were to revive, say now, yesterday's, I think there's a relief rally, or the a kind of relief that the Fed put hasn't. The Fed put is basically every time there is a sign of a recession or threat of a recession, the Fed
I,
can't. retreats and lowers interest rates. Yes.
So I wanted to ask you about this thing because this relief rally that you mentioned, this is essentially a confidence thing. Now, one thing is that obviously you said that contrary to what a lot of people tend to or are saying, what I've read is that India may benefit out of the woes of the American economy is not true. First thing, from what I understand, is that true? From the first two channels that you said, trade.
It's a mixed bag because what the discourse in India is pointing out to, the narrative is that a recession or a slowdown in the US will push down oil prices. India, being a net commodity importer, suffers extraordinarily harshly compared to relative to any other of the EMs because it's a net commodity importer and its imports are very, very high. Dependency is very high as far as oil and other commodity inputs are concerned. And it pushes up inflation. So, its macroeconomic instability is seriously risked every time the oil price or global commodity cycle rises and shoots up to the skies. The fact is that you can have low inflation, but of course there are the feedback effects through both trade, finance, and confidence channels upon growth. So there's going to be a setback to growth outcomes. So there's no free lunch, as I said. You can have low inflation, but you will also have a setback in growth. That's the aspect which is not being adequately absorbed or assimilated into the discourse, in my view.
Now, since you mentioned about growth and its impact on India, we'll come to the growth outlook for India a little later, but I want to just take a step back because many of our viewers are not necessarily students of economics, and they want to understand what it means. The IMF report has been seen in two different ways. One view is to look at the dialing down of India's growth, that almost 80 basis points has been dialed down for the current year and another 80 basis points for the next financial year. So one view is to look at that, IMF has singled out India, China, and US for dialing down growth. The other view, which is perhaps the more dominant view, is to say that, listen, after all of this, India is still growing or going to grow at 7.2 and the next year at 6.1. And this is, amongst the major economies, this is the highest, fastest growing economy, and everything is fine in that sense. We are at the top of the heap. Now, what I want to understand from you, because you've looked at from the IMF lens also and from the RBI lens also, how does one go about understanding what is a good growth rate for India? Looking back in history, we never find that US typically grows at 8 or 9% or ever grew. They grew at a very small rate over a long period of time. It is India and China and such economies which have sort of grown at this rate. So if you could reflect a bit about what is how does one make sense of India's growth rates? What is the minimum that we must grow at? I was talking to one economist, and off the record, he said that, listen, we don't need to actually grow or contract to feel like recession. Even at 4% or 3%, we'll feel like a recession because we are so many people in the economy. So could you reflect a bit, first of all, how to understand growth before we get to the actual numbers for India?
Yeah, there are a lot of questions and sub-questions in there. So I've flagged the main instance. So I'll take my time to answer this. First of all, let's start with the IMF markdown by 80 basis points, and that was 8.2, so it's now come down to 7.4%. And let me say that first of all, that it's much closer to the RBI's prediction of growth this year in FY23, which is 7.2%. But there are analysts who have lower growth rates than that, between 50 to 60 basis points. I think there are some projections which some people expect even 6.5 or 6.6%, I think. I'm not sure though. So, the correct way to see this forecast, whether it's 7.4 or the RBI 7.2, that's immaterial, there's not much difference. And also the markdown is something which was expected. It's not at all unanticipated. There has been a huge increase in inflation, and there have been many changes, and boats being rocked all across the world. So that's not the issue. The issue is, how do we look at this headline? I think it's very important to understand or explain that this headline is very misleading. It's a misleading number. 7.2 is not exactly, well, it's not 7.2. A lot of this is boosted to this 7.2 is coming from the first quarter, which is of this financial year, which is the April to June quarter, in which the RBI's projections show that growth will be 16.2%. Now that 16.2%, we will, because these numbers will be coming out on August 31st, very soon, the first quarter, and we may see a big enough number. And then we will again have these headlines saying that, India's growing so fast, it's roaring like a tiger. Anyway, the point is that the 16.2 comes upon this number, the whole of the year's number is hugely influenced by a base, and what is typically called by economists as, or statisticians, as a base effect. And the base effect is largely coming from the first quarter numbers. The growth is expected to be 16.2, but that itself is coming on a very distorted base last year. India had a very bad second wave, and April, June was the peak. And at that time, if we see the, although in terms of the growth, GDP growth, even last year was 20%, that 20% came upon a 24% contraction the previous year, which is April to June 20. So let me deconstruct that a bit. So, let me put this 16.2% this year in perspective. Let's look at it, how fast, how much India was above or will be above in April and June to June, first quarter of 2022, relative to the April to June quarter of 2019. Turns out it will still be about a little more than 8% lower in terms of growth rates and where the level of GDP will be. So, after this base effect is adjusted in next year, and if we see the second half of this, what is called the fiscal year 22-23 or FY23, to put it in a short form, it actually growth decelerates very sharply in the half one. When the base is adjusted, if you remove that distortion, it comes to, even the RBI's projection show that it is expecting the economy to grow only at 4% in the second half of this year. And that is close or almost even with what the Indian economy was growing, the rate at it was going in 2019-20 at the eve or pre-COVID. Pre-COVID, India's GDP growth for that full year was 3.7%. And so, if we take out all these base effects and the fact that in the second half, the economy is going to slow down, and, after adjusting on an adjusted base, overall growth would not be actually just any more than, it would be somewhere in between 4 to 5% this year. And that is the way to look at these headline numbers, and not, I think it has to be moderated, the euphoria or the optimism about that it is good. I would say that India's actually, for this year, for Indian economy, is the key year of recovery. It is not FY22 as in the case of the rest of the world or other economies, primarily because we had a very bad second wave in the first quarter of last year. So this is the first year of recovery, FY23. It's a recovery year. And if growth is, recovery is about, say, 4 to 4.5% or 5%, even if we were to take at the optimistic scenario as 5%, then let's take the next year's projection, FY24. The IMF, for example, is predicting 6.1. And so, 4 to 5% this year without too much of a recession or anything, because maybe the RBI may revisit its own forecast in August, or maybe subsequently maybe in October. We do not know as yet. But the point is that after a 5%, a 6.1% growth is not good enough for India. Now, that brings out to the next aspect of your question, Udit, which is 4% or 8%, or what's the right growth rate? I would say that India would need, without any of these distortions of base, etc., just to absorb the enormous amount of slack which is in the labor market, which is basically your unemployment rate. Even at the most distorted estimate, and we don't have very good employment data, we would say that roughly the overall unemployment rate is anything above 10 to, anything between 10 to 20%, because there's a huge amount of people who are disguised unemployed, which the joint family system takes care of in India, or, who have reverted back to agriculture, which is a kind of a regression. And we can see this in the PLFS, or the, periodic labor force survey reports. And typically, as an economy develops, then it's the process of development is from the primary to the secondary to, and then on to the tertiary sector, which is from agriculture to manufacturing, and manufacturing to services. So, to see a fallback, or, reversion to agriculture is not at all a good sign. So India needs to grow at least somewhere between 7% to 8% on a cumulative, continuous, steady state growth basis, and in order to absorb this surplus labor. So that's the difference between where they are, where the US is, or all the rest of the advanced nations are growing at 4%. And one other point is that for them to grow at 2% or even 1.5% is okay. Why is it okay? Because these economies are advanced, so-called advanced. They've reached, as I said, at a stage of development, which is very high. Their average income is very high on a monthly basis. More important than that, in order to reach that stage, these countries are at what you call the production possibility frontier. It's a technical term, but for the non-economic viewers and readers, let's put it this way, which understand it this way, that they have exhausted all the resources available to them in order to, as inputs, which is labor stock, which is the investment, that is capital stock, and technology. Whereas countries like India or emerging markets are way behind below the production function or the production possibility frontier of the global economy. And there is a lot of catch up to do.
Okay. I would like to end the show by asking you, I typically ask my guests about a more long-term question, and we've discussed this in the past between us, about where is the next growth fillip coming from for India? India's economy, there are different levers, there are different engines of growth. We have looked at personal consumption sort of holding us in good stead right through the last few years, while banks were busy with NPAs and corporates were busy with their balance sheets. But increasingly, it is being said that private investments is going to lead us out of this crisis. Because the global environment, as again you've so well articulated, it's very uncertain. It's unlikely that our exports are going to take us out of this crisis or this phase. Personal consumption is down. There are household debt is high. So private investment seems to be, this engine which might, which everybody is hoping for. The other engine, fourth engine, is obviously government expenditure going up. But there again, the crisis is of fiscal deficit being high and that having its own set of problems. So when you look at GDP and where the growth may come from, more not just from a 1 year or 2 year perspective, but more maybe over a medium term perspective of 5 to 10 years maybe, where do you see growth coming for India? What is going to drive India's growth?
Let's first you have explained the growth drivers, the 4 growth drivers very well. And let's start with the external situation, external demand. The prognosis of world trade revival and world demand is so far no good. There is not very good in the near term. In the near term, even if the US economy avoids a recession, the extent of tightening and so on is sharp enough and can be, there's no way it can perhaps, control this kind of, because even if the GDP contracted, you must see that, what the US spending or personal private spending was, it's accelerating at a very high rate. There's no way you can, that demand has to be slowed down. So in the medium term, the US economy may well see a recession, but one is not sure about that. But there's no way to bring down this kind of level of inflation to its target of 2%. without actually crimping or compressing demand very sharply. That's the trade-off. So in the medium term, external demand is very uncertain. Let's hope that it revives and some bit of, but besides that, there are other drag downs on global trade, which is the fragmentation, including issues like after the Russia war, as it is, there was an increase in protectionism earlier. Over the last, there was this US-China trade tensions. Even before that, from 2012 onwards, all the G20 countries have been raising protectionist barriers. So in the overall sense, what we saw in the go-go years, the world trade growing at about 1.5 times above GDP, we have not seen return to those levels. So export demand, it would be reasonable to expect that it could not be a significant propeller unless there are huge changes and increase in competitiveness gains and productivity gains within India, and that's a matter for policy attention. The real worry at this point is actually the revival of consumption, because recovering from the pandemic and recovering from before that the slowdown, which has gone mysteriously undiagnosed. A 3-year slowdown and growth slips to 4% in 2019-20, and no one knows. I mean, there is no real clear-cut diagnosis that, okay, this is the reason why the economy was decelerating for 3 long years from FY18 onwards, right? So we have that in the backdrop, and consumption through this period was sustained. It kept going. It's about 57, or historically it's even been 60% of GDP at one time. So but a long-term average would be about 57% of your GDP. The contribution is enormous. In the between FY18, between 17 to 18, for 3-4 years, it was supported by enormous borrowing. But then the NBFC crisis happened, and there was a huge slump. Houses, if income growth is decelerating for 3 to 4 years, obviously consumption, we know that the consumption function, the key determinant is income, and if incomes are going down, obviously consumption is going to slow down too. So that's the real worry. What we are seeing now in the incipient recovery, the signs are, as I pointed out earlier, and even the RBI governor has highlighted this, the monetary policy statement has highlighted, India seeing the recovery is there. It's robust in some elements, but it's very, very uneven. So, we sees the fact that the large portion of the largest portion of India's aggregate demand is the bottom of the pyramid, which is the low income earners. If that is not, if they are in the lower stroke of the K, it's reason enough to worry. And then on top of that, we have these shocks of having been forced to tighten monetary policy so early in the stage of a recovery, and a global recession on top of that. So I think that's one of the biggest worry on that. I think the prognosis is not so good. Over the medium term, it is to be hoped that it revives, but then how does consumption revive? Consumption is, after all, a function of income, which takes us to the role of fiscal policy or government spending. The government did roll out a huge, one of its, highest levels in quantitative terms, amounts, right? And now even recently, the FM has reassured that no matter what, that capital expenditure will not be cut down. But we must remember that those were nominal numbers, the 10.10 trillion rupees that is to be spent on investment, public investment and projects, etc., in real terms are much lower, because compared to your nominal GDP was expected to grow at 10%, but now it's going to be growing at more than 17%, right? So in real terms, the spending has already come shaved down, because cement prices have gone up, steel prices have gone up, and so on. All the construction inputs, including part of the payments to suppliers, and including labor costs, would have gone up too. So that is not going to be giving that much of the impetus or a kick to the economy as would have had inflation remained between its 4 to 5%, 4% region. So that's your third pillar. Now, that leaves private investments. And at the start of the year, when the budget was presented, or the monetary policy review was rolled out for the new financial year. Of course, there was no Russia-Ukraine conflict at the time, but these were the drivers that in the first round the government would stimulate through its own capital expenditure, and then investment would come back. Why would it come back? Because the banks which were weakened and their balance sheets were damaged, they have repaired. Corporate balance sheets have repaired too, and they are in good shape, and therefore they are ready to go. And it's only that the economy has to recover, consumers have to come back to the market and start buying things. But our first quarter results show that particularly the FMCG, which is Hindustan Unilever and all, their early estimates show that actually volumes fell down, were declined, contracted by 5%, number one. Number two, we also see that there is increasing evidence that corporates are actually not investing, and they're either paying out dividends or they're buying back their own shares, which is not a good sign at all. And they've been doing the same for the last several years. And considering the fact that India has seen virtually very slow and feeble investment and never recovered to the earlier levels, which a healthy economy like India, underinvested economy, should have been seeing, or what it saw in the phase from 2004 to 2012. It's a 10-year long slowdown. So it brings down to the idea of what is this potential. If an economy has not seen really meaningful investment for more than a decade, and then there has been severe damage from the pandemic, we don't know what India's potential output is. The common perception is the concept of potential output. I will just explain shortly in simpler language. But commonly, it is assumed that agencies like the IMF or RBI or analysts in general, they are taking India's potential output as somewhere around 6%. The concept is that India has the potential to grow, or it is capable of growing at 6% each year annually without running into roadblocks, inflationary roadblocks, without giving rise to inflation, and which would again, bring down, put a stop to that growth rate. The question is that has potential output been damaged? And that damage in real terms means that how many businesses have shut down, how many people have lost jobs, how many people have lost their incomes, and that is where your potential suffers, which is the supply side of the economy. How much has it been damaged? It is clear because from 17 onwards, Indian growth was decelerating, that no matter the amount of public spending that has taken place, it has been inadequate or it is inefficient to revive growth in a meaningful and place it on a robust footing of 7 to 8%. So, there are issues. These are medium-term issues. If potential has gone down below 6%, then the capacity to grow is constrained. It will take time for it to, because new supply side additions will have to come about to bring to allow the policy space for both the monetary policy as well as fiscal policy to grow. And then we all know that the debt, this general government debt, is about 90% of GDP. There is no money, so to say, to fire the economic engine further. So medium term, I would be very realistic, and I would say that the capacity would be under, around 5% or even lower. And I don't think that the government itself sees that, because even the budget projections, the budget does not project the medium term, but they do have to, under the FRBM rule, they have to put out a medium term fiscal policy statement. And that itself shows 5.5% is, implicit assumption. That's what I had inferred from that.
So thanks a lot, ma'am, for bringing out the complexity of what India's growth has to deal with. Often the discourse in media is very simplistic, and we hang on to numbers, 8%, 7%, and everything behind is forgotten of what may be creating this 7% and whether this is good enough or not. And I hope our viewers would have understood a few things. One is obviously the complexity that a US economic recession and global recession might bring to India. Oil will be cheaper, but there'll be other complications, as you would have understood. And the other thing is the complexity of India's own economic growth story, which is, as Ms. Kohli very rightly pointed out, that there is an undiagnosed issue of what happened to India's growth between FY18 and FY20. Why was it slowing down? And there is a larger problem of not having seen investments and having exhausted personal consumption in the last decade. So when we look ahead, there are massive challenges to our growth. Yes, we will be better than the rest of the world in numbers, but you have to understand how to appreciate those numbers. And that also, Ms. Kohli, so well articulated why and how you should appreciate a 6% or 8% in India's context as against another country. Thanks a lot, ma'am, for sparing so generously of your time and insights with us and my viewers. And I hope the viewers got something about the understanding of the economy. Please keep watching. We'll be back next week with another episode of The Express Economist. Thank you.